Let's break down what's been going on with US Fed's monetary policy recently. So last Wednesday, the inflation numbers in the US came out, and honestly, they weren't what most people were hoping for. Inflation in the US rose to 3.5% in March from 3.2% in February, above the Fed's target of 2%. Now, this increase exceeded Wall Street expectations and was primarily driven by rises in the cost of fuel, housing, and clothing. Additionally, core inflation, which is often looked at to get a sense of the underlying inflation trends because it excludes the more volatile categories of food and fuel, stayed constant at 3.8%. Now, this isn't just a minor uptick, it's a signal that inflation pressures remain stubbornly high in the US. Now, diving into other economic data in the US. In March, non-farm payrolls, which basically counts the number of jobs added outside of farming, saw an increase of 303,000. Now, that's a strong indicator that businesses are hiring more. On top of that, wages are also on the rise, with average hourly earnings going up by 4.1% compared to last year. And the unemployment rate in the US has dropped to 3.8%. So what does all this data mean for the Federal Reserve and interest rates? Until now, there were expectations that the Fed would cut interest rates 3 times this year, with the first cut likely to be in June. Now, with the US economy showing strength and inflation rates higher than expected, the Fed might have to rethink or delay any plans to cut rates. They might be concerned that lowering rates could lead to more inflation, making it even harder to get it under control. In summary, while many were hoping for rate cuts to support economic growth in the US, the reality of high inflation and a strong labor market might lead the Fed to hold off on these cuts to avoid adding any fuel to the inflationary fire. Now, the situation is dynamic and could change with new data, but for now, that's where things stand. Now, China's economy has been pretty rocky lately, and it's also catching the eye of some major financial watchdogs. In December, Moody's adjusted their view on China from a stable to a negative credit outlook. Now, this week, Fitch did the same thing, pointing out a few worrying trends. According to Fitch, they're seeing China's government debt, which includes both central and local levels, expected to jump quite a bit. It's projected to rise from 56.1% of GDP this year to 61.3% next year. Now, just for context, back in 2019, this was way lower at 38.5%. And the growth look for China isn't too rosy either. Fitch thinks China's economy will grow slower next year, down to about 4.5% from 5.2% this year. It seems like the recovery from the pandemic is turning out to be a slow grind for China. Now, despite these concerns, Fitch still keeps China's credit rating pretty high at A+, which means they believe that the country isn't at an immediate risk of defaulting on its debts. It's like saying things look shaky, but it's not panic time yet. Now, here's where it gets interesting for other countries like India. With all this happening in China, you would think that investors might start looking elsewhere. India, along with Vietnam, Bangladesh, Indonesia, etc., are all seen as possible new hotspots for investments that might have gone to China before. But it's not just a walk in the park. These countries are in quite the competition with each other to attract that investment. In March 2024, there was a noticeable downturn in equity mutual fund inflows in India. Compared to February, investment took a 16% dive. Now, that might sound like a red flag, but let's break down on what's really going on here. When we delve into the details, we find that the small cap funds and focus funds took the hardest hit, experiencing outflows of over 100%. Even mid cap funds weren't spared, facing a 44% outflow. On the flip side, large cap funds, ELSS, and dividend yield funds were the shining stars, attracting significant inflows. Now, if you look at the bigger picture, the overall equity mutual funds witnessed a 16% decline in inflows. Now, what could be behind this downward trend? Firstly, a major factor is the ongoing concerns surrounding liquidity in the small cap and mid cap funds, along with high valuations in these segments. Secondly, amidst the market volatility, particularly in the mid and small cap sectors, investors are playing it safe. They're shifting more of their investments into large cap segments and rebalancing their portfolio to reflect a more cautious approach. So it's not all doom and gloom. While the dip in equity mutual fund inflows raises some eyebrows, understanding the reasons behind it gives us a more clear picture. Now, it's a reminder of the dynamic nature of the stock market and how investors adapt to navigate through these ups and downs. Having said that, this is me, Merlzana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.